All right, everyone, Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced, negotiated in the past, and we analyze them, see if there were some lessons that we can take out of these deals. And the ultimate goal of these videos is to support all the business leaders, investors, and entrepreneurs looking at buying assets in the Middle East or in the United Arab Emirates. Hopefully some of the mistakes I made and that our company made can save you time, resources, and money, and can also share a little bit of details around how people behave when it comes to deals here in the region and support you in the journey. So this is the goal of these episodes, and in this particular one we're going to be talking about a deal that got offered to us 2 years ago. Of course, as always, I'm not going to be sharing any sensitive information to keep everything very confidential, but I'm going to give you a little bit of an outline of the deal. So in this case, we were talking about two separate businesses that were fundamentally combined into another entity. So what happened was the owner of these businesses had a holding company and was managing two different locations under this holding company. He then decided to integrate these two businesses into one single business because he thought he could rebrand everything and create a single brand out of these two locations. So the company itself, so the two entities and the holding, had been around for about 10 years. Of course, the new entity would have been brand new, but we were talking about two established businesses in a staff count around 40 people, so 40 employees. Now, there was no real estate involved, and the reason why this guy wanted to sell these two businesses was because he wanted to grow the new entity a lot faster. So fundamentally, his goal was to focus all his attention on one business, combine the two that he had in the past, create a new entity, and then scale it from there. So fundamentally, he was looking for a way to give up a bit of equity of that deal, or potentially give up control entirely and just stay as a minority owner to provide people with the know-how and expertise, and then see that business flourish and grow. So that's kind of like the initial overview on the deal. Now, before we dive into the problems, let me give you a bit of the financials of these deals. Now, they're going to be less relevant, but I'm going to be sharing the financial performance of the two businesses before they were merged, and then what happened to the business after it started operating as a single entity. So when we look at the two deals separately, one location was generating $1.6 million a year in revenue, in a loss of about 150 grand. So not a big loss, 10% loss overall, close to break even, not particularly good as a location, right? The other one instead was pretty good because it was generating about the same amount of money, so 1.7 million in revenue, but it was also making a good profit, so $750,000 a year in net. So the two locations were completely different, right? Some of the reasons behind it was because they were serving two types of clientele and they were providing different services. So that might have been the reason why the businesses were operating differently. And true to be said, they were also operating in two separate, geographic areas of the United Arab Emirates. So that might have been one of the reasons why they were not performing so well. But those are just background information, because what we were offered was an opportunity to buy into the consolidated entity, the new entity. Now, the new entity was undergoing a bit of stress, to say the least, because it was fundamentally generating the revenue of one single location. So the combined entities were making 1.6 million a year after merger. So the same amount of money of one location of the past, but they were losing $2.5 million Now, I'm not gonna dive too deep into the numbers, because the moment we saw the business was struggling at this level, we immediately decided to pass, because that's not what we focus on. We buy profitable entities, and this was immediately a pass for us. But I think the lesson I can take away from this deal was something that we discussed in the initial meeting with these people. And it all comes down to what was the rationale for selling the business. So they were opening up the doors for either a minority investor or a total sale or majority sale, let's just put it this way. Now, the first option was, of course, ludicrous, because the business was losing a lot of money, and it appeared like they had started something from scratch all over again. And so they were fundamentally asking an investor to take a risk on a newly started business to save them from the financial losses that they experienced in the short term in pursuit of long-term benefits, which of course was very risky. I'm not sure a lot of people would take that bet. We certainly didn't. But I think on the other side, when we talk about a majority control, which might have been more interesting, still it didn't make much sense, because it appeared like these guys wanted to, again, mitigate their losses in the short term and still get to benefit from the long term. Of course, they tried to sell us on the vision, on the fact that this was just part of the process, because they were fundamentally rebuilding and reconsolidating these two entities together. But it was simply too much risk for us, and not really something worth putting our money into. To be totally frank, if they were to come to us before merging these two entities and say, would you be interested in buying one of those, we would have bought the profitable one, no question asked, really. The business was making, how much did I say, 1.7 a year in revenue and 750 in net, so it was a okay business. The other one we would have bought, of course, but still they could have made a good money, a good exit out of that entity, and potentially close down the other if they wanted to pursue something else. But it appeared like they were not really considering closing down any of the two, and they decided to plug everything together to try to grow it to a whole new level. My reflection on this, and of course I didn't have enough information because I just reviewed the investment memorandum they sent to me, was that another option could have been closing down one facility and just transition all the clientele they had into the profitable one, and add services to that business so that they can continue provide the same product line while at the same time satisfying the customers. I think they didn't want to go down that avenue. They wanted to create a whole new concept. In fact, the two old facilities were shut down and they moved everything to a new place, which of course was also a big challenge, right? Because they kind of like, again, the point of reference they were in the past as a business, as a name, and as everything they represented disappeared the moment they started rebranding. And they weren't a big conglomerate, right? They were a small company. So client inflow might have been affected. And, I don't know if that decision was the right one. Of course, based on what they said to us, this is a 3 to 5 years plan, which I might believe in that statement, but still not something that was worthy for us to invest. I think the lesson, again, the takeaway here is that these guys embarked on a very ambitious journey, and then they realized that the short-term losses were heavy, and so they were trying to mitigate that problem by bringing in somebody who could add some oxygen to the deal. Not really something we were interested in, but I think this is a situation that we faced many times in the United Arab Emirates and in the Middle East, let alone the concept of merging two companies, which is very complex. I'm not sure it made sense in this case, but let's just say a single entity that is struggling or trying to catch up with the market. A lot of times you will find out that people are selling either majority or minority to to stay afloat, and they're kind of like going down the startup route. So they're raising their series of money to try to then ultimately become profitable. But the problem is that with a lot of these brick and mortar businesses, we're not talking about a long-term payoff. That is an idea that can be then sold for a lot of money. We're talking about very tangible services and products that, if they're working, they will work after 2-3 years of you operating the business. If those things are not working, chances are something is broken inside. You either need to fix the business or change something internally before you raise money, because you cannot buy your way out of that problem, right? They will simply escalate. So if you have a working capital constraint, that will still be the issue, even if you get new equity investors and all these sorts of stuff. So my perspective was that there are a lot of people who will try to do that to solve their cash flow problems, their financial issues, and kind of like put a patch on their business. But in most cases, there's very little that can be done if the business is broken from the inside. And by the way, this wasn't the case for the two original companies, right? Because one appeared to be working well. The other appeared to be break even or a little bit of loss, but everything went okay for one. They could focus all their attention on that instead of spreading their attention and just doing a lot of things at once. And that's just my comment and my perspective on this deal. I might be wrong. Maybe 5 years down the line, they will be super successful and super profitable. But at least the time they share with us the deal, it appeared to be a losing deal, and that's why we decided to pass. And also the time when we learned that many times people will try to get you involved in buying a business. Well, in reality, all they're looking for is an investor that will bail them out of trouble. So it's a big difference. And that's what we took away from this deal. So hopefully you can find this case study helpful. I'll see you in the next episode.